Thank you all for being here. Appreciate it. Yeah. All right, so I have clients come in my office pretty much every week. First time I have conversations with them, and we're always talking about LLCs and how they have their business structured. And a lot of them have, paid a bunch of money to have this convoluted structure set up, but they don't actually own anything yet. So it's like you don't need that. But what I wanted to talk about today was how to use LLCs in real estate investing. And I call it using LLCs for fun and profit because I think this stuff is fun, so for me it's fun. But it's basically how to use LLCs to structure real estate environment. First, I want to say what an LLC is. It's LLC stands for Limited Liability Company. It's a separate legal entity from the owners. So it can own real estate or any other kind of property. It has to be run by a manager, which is usually the owner in our case. They were created originally in 1977 in Wyoming, and since then they've been adopted by all the states since about 2000. I'm not sure when the last state was. Louisiana, I think, adopted it in like 91 for LLCs. Now, one thing about this is when Wyoming created this new LLC, they had to figure out how to tax them. And so at the time, this is the type of entities that you could have in 1977. You can be a sole proprietor, which means you're in business for yourself. You don't have a corporation. You woke up one morning and decided you want to go out and earn some money. Then there's a partnership that's two people who are sole proprietors essentially, or more, that get together and they decide to just run a business together. The two things about those is a sole proprietorship and partnership, there's no liability protection. You're just, whatever decision you make, if you cause damage, you're going to get sued personally. There was a corporation, which was another option that you could do. That's where you set up a separate legal entity from yourself. It has shareholders, stock, all that stuff, but it's a separate legal entity, and it gave you some liability protection. And then about 1960, the IRS, or Congress, I guess, came up with the S Corp because a lot of small business owners, a corporation was too expensive because the downside of a corporation is you pays tax. And when you pull money out, you pay tax on it again. That's called double taxation. In 1960 or thereabouts, they created an S Corp, stood for small business. So if you have a corporation, you can elect to be taxed as an S Corp. And then the income flows directly to you if the S Corp doesn't pay tax. Well, in 1977, the IRS looks at this. They were thinking, we're going to have to write whole new sections of rules for all these LLCs. But then they looked at how the LLCs were operating. I'm pretty sure that they were set up, this is my guess, in Wyoming, to give liability protection to sole proprietors and partnerships. And they said, well, if there's a single member LLC, let's tax it as a sole proprietorship. It'll be disregarded for tax purposes, which is a fancy way of saying it doesn't have to file a tax return. The owner files a tax return. It's a Schedule C for the business, or Schedule E if they're a landlord. If it has more than one member, we'll call it a partnership. It files a partnership tax return, which is a separate tax return. And then the partners get K-1s from that, which shows it reports their income that they have to report on their tax return. And it says, while we're at it, why don't we allow them to elect to be taxed as a corporation if they want, and they can be taxed as an S Corp if they want. So an LLC has these choices, so it's the most flexible entity out there. Now here's some benefits of LLCs. We talk about liability protection. It's considered its own business, so it's separate from you, but it can stand alone. You can sell it. It can pretty much run any kind of business through it. A marketing entity, I have a lot of clients that do this. They like a name, but instead of going through and setting up a whole nother structure and employees and stuff, they just have the LLC. They market under the LLC, but that LLC is owned by their other entity. And so the consumers or whoever they're marketing to sees their marketing company. They don't realize that it's just a subsidiary enough. It gets its own EIN because it's a separate entity, so it gets a tax ID, and that's for a business that's called an employer ID number or EIN. And this is important because if you do business with a company, if you provide services, you're required to issue 1099s to those companies. Well, if you issue 1099s to LLCs, it goes to them, and then the IRS doesn't know where that money's going. That's why they're setting up this beneficial owner index thing, that information database. But the key thing is you need an EIN number to open a bank account for your LLC. I just set up an EIN for a client yesterday who set up an LLC a year ago, was told, oh, you don't need an EIN. But now he wants to open a bank account. It's like the bank says, you need to be earning. And that's the bottom one, is of course it can open some bank account. So you can have money in that and it runs everything on its own. All right. Here's a general rule of taxation. If you make money, you will owe tax. I get so many people come to me and say, I made all this money, how do I not pay tax? Don't write the check and then go to jail. I don't know. It's like, but we talk about, so the secret to saving tax is understanding the tax code. The tax code is a system of incentives for those of us who follow it on how to pay the least amount of tax. It has rules in there. If we follow that, it tells us where to go. And one of the key things about it is not all income is taxed the same. So there's passive income, results in the lowest tax. Passive income is income from your investments, I think I have another slide in there. Active income results in the highest tax. So active income is money that you earn. So here's where I've defined it. So active income is what you get paid to do work. So if any business where you're selling services for a fee or something like that, that's active income. Passive income is you get paid from your investment. So that's interest, dividends, and it turns out rental income. Now it turns out rental income is passive only by definition of the tax code. Because if you're a full-time landlord and you're doing the repairs yourself, you're collecting all the rent, you're managing all the stuff, finding the tenants, you're working your butt off, but it's still considered passive income. So that's actually the best place to be because you pay the lowest amount of tax. All right, flipping and wholesaling are active income. So that active income activities, you're going to pay a lot of tax. And if you do too many of them in a year, you're in business for that, and the IRS sees that as an active business, and you're going to have to pay self-employment tax. Rental income, of course, is that. And dealer income is active income. And I have a, what's a dealer? So if you think about, when you hear the word dealer, a lot of people think auto dealers. Well, the thing with a car dealer is that they can own a building, and the IRS does not confuse the fact that their building that they own for their dealership is an investment for the business or the owner or however it is. They don't confuse that with them selling cars. But when we're in real estate, they get confused because if you're flipping properties, you're an active, you're basically a dealer. The definition of a dealer under the tax code is a person who buys something with the intent to sell it in a short period of time for a profit. Well, that's what you're doing when you're flipping it. That's what you're doing when you're wholesaling it. You're not doing that when you rent properties because you're not intending to sell it immediately. And so, but if you're doing both activities, if you're doing both of those activities, the IRS might come back and say, well, you're a flipper, means you're a dealer, so therefore your rental income is also inventory, and there's no benefits, tax benefits for inventory, and then it's considered active income. Rental income is still passive, but when you go to sell that rental property, you don't get long-term capital gains, you can't do a 1031 exchange, you can't sell it on an installment sale. There's a bunch of negatives for being a dealer. So, so for you guys that are flipping, you need to figure out how to convert your flips to rentals. And one way to do that is to sell on a lease with an option to purchase it. Make it a rental first. Give it some time. Make sure it's in a separate LLC, which I'm going to talk about here. Or sell it on bond for deed, or sell it on in some format that it shows that it's a rental for a while. And then now you're in the passive category, and then when you sell it, you still can get your capital out of it, your equity, and plus you can convert it to a long-term capital gain, which is taxed a lot. Okay, so separate your rentals from your flips using LLCs, and that's the easiest way to do it. And LLCs are sort of unique. They provide liability protection, which you talked about. They're easy to set up. They're taxed based on the ownership, so if it's a sole proprietorship or an S corp or whatever, they can own anything a person can. They're passive entities and they're legal in all 50 states. So LLCs for income type. So when people come to me, it's like I look at what they're doing and I make sure they have the proper LLCs set up and the elections and all that. So if you have an active income, so if you're a flipper or a wholesaler, you're going to want to have an LLC for marketing anyway. But it also puts a wall around the activity you have and shows that it's distinct from you. That's one of the benefits. After you get above a certain income level, you're going to want it to be taxed as an S corp. And the reason I say after a certain income level is because the one rule for an S corp is that the owner has to pay themselves a reasonable salary. So that means, and an S corp has to file a separate tax return. So all of a sudden, when you elect your LLC to be taxed as an S corp, you're filing a separate tax return, and you have to start doing payroll, and there's a lot of extra paperwork and everything involved. And you can avoid that if you don't need to do that. So most of my clients that are just starting out, I have them set up an LLC so they can start marketing and doing what they need to do. And then when their business takes off, some of them it takes off the first year, some of them it takes them a while for that to happen. Then we elect them to be taxed as an S corp. Now, and I'm going to talk about the benefits of that in a second. So LLCs taxed as a partnership are best for passive income from rentals. And one of the reasons for that is S corps has special rules. There's, some of you may be aware, there's what's called the passive loss rule. So if your income is above a certain level and you have rental losses, those are passive losses, and you can't deduct those against your other income. And that income level is $150,000. So I have a lot of clients that are making more than that. Pretty much two spouses working are getting pretty close to that. And they can't deduct any of their rental income against their other income unless they're a real estate professional, which we'll talk about later, or in another talk, I guess. But an S corp has the passive loss rule as well, but they also have what's called the at-risk rules. So if you go and borrow money to buy a property and you have it in an S corp and you have a loss, you're not at risk for that debt yet, because it's even though you may personally guarantee it, the IRS doesn't consider your debt until you pay it off. So what happens is you don't even get to take the losses. And so with real estate, we're highly leveraged. Now, some of you may not be, but for most of you, when you're getting started, you're borrowing money. So it's best to have the rental real estate in a partnership, because under the partnership rules, you can actually use that debt as part of your investment, and you get to take the losses. So LLC's taxes is sole proprietor, which means it's a single member LLC. You're just starting up. That's best for startups. It's good to have an LLC. And then, of course, it's disregarded, so you don't have to file a tax return. But, you know, sort of my basic rule is start out with the LLC first, and then see how the business grows, and then you can decide to switch to one of these others. Now, to be a partnership, you have to bring in a partner. Now, one thing I will say about that is Louisiana is a community property state. And they're non-community property states. They're mainly west of here. There's a special rule for community property states. So if a husband and wife are partners in an LLC, they have the option to either treat it as a disregarded sole proprietor, or they can treat it as a partnership. So depending on, and we use that strategy as well, depending on what they have going on, sometimes it's better to file a partnership tax return to show that all those rentals are separate from you. Joint ventures. This is a fancy way of saying a partnership. Now, a lot of people do this wrong because they don't think of it as a partnership. They just call it a joint venture, but they're basically partnering to get a deal done. And there are several ways to do that. And I say income type becomes an issue because of how the income flows through to the partners. It could be a true partnership where equity is shared, you'll both invest money and flip the house, and then you split the proceeds. One partner, joint venture partner, could actually really be a lender. So they're actually lending money, and they don't have ownership in the property other than they might have a mortgage or a lien against it. And then the other one is a contractor, where it's like the contractor, you as an investor could partner with a contractor. The contractor comes in, uses their expertise, and they're going to get paid a part of the profit at the end of it. But any payments you make to them, you're going to issue them a 1099. You're going to treat them as any other partner contractor. The issue becomes when you have two people that you decide to do a joint venture and you're doing flips, and it's self-employment taxable income, which means you pay extra taxes on top of income. And then that income flows through, and it's like, how do you report that income to the IRS? Some of you may say, well, let's not report it. Why don't we just not tell them? But no, you got to report it somehow. And it becomes because one of you in the partnership is going to get a 1099-S when you sell that property. The 1099-S reports to the IRS the sale price of the property. And so the IRS is going to be looking on your tax return to see that number shows up. If it doesn't, you're going to get a tax bill. And so part of that sale price you pay to your partner. Now, if it was a partnership and you filed a separate partnership tax return, it's handled a lot easier. So you have to be aware of how these things are set up. So I just wanted to point that out because a lot of you guys use the term joint venture, but you're not really thinking about what is truly the legal structure there and the tax structure that you need to set up to make sure it all works when you get the money. Now, syndications is a fancy way of saying LLCs or partnerships. Most of them are really huge. The big ones that you hear about are used to pull money. They get a bunch of investors in to buy a big apartment complex or commercial something like that, and then they borrow money. So they get a group of, let's say 20 people invest $100,000 a piece to get in. You got $2 million, and now you can go buy a bigger building because you got the down payment and all that stuff. Any partnership structure is essentially a syndication. It's just a fancy way of saying partnership. Now, there's a bunch of different legal structures and ways that these things are set up. And I have to wear the hype because I have a lot of people sending me pro formas and brochures and different things on different syndications. They want me to tell them what the hell it says. And I look at it from a tax standpoint on how the money flows through it. Legally, that's what John would do. He could tell you whether it's a good language is fine, but when it comes to the business structure and taxes, I understand that stuff. A lot of these guys are pitching things. One of the biggest things they do is like, when you invest in this, we're going to do a cost segregation study. We're going to take a big depreciation deduction that's going to flow out to all you guys, and you can save on your taxes. That's not how the tax code works, because unless you're a general manager in the syndication or the LLC, you can't actually take those losses because they get hung up in the passive loss rule. And so most of the K1s that you get from these have a little checkbox saying you're a limited partner. Even if you're a real estate professional and you can write up all your other stuff, it still gets hung up. So you have to be careful of that. And then also right now with the market changing, I've seen stuff where they're still thinking they're going to refinance the building at 4%. It's like, what? No. And it turns out the cap rate that they bought it at was 3%. I said, they're screwed. Don't buy into this one.
Can you talk about what the IRS quantifies as a real estate professional?
Sure. A real estate professional is a person who spends more than half their time on real estate trades and investments. That's the first test. The second test is they spend 750 hours or more a year. So if you have a full-time job that's not in a real estate related field, you have a hard time meeting that first test more than half your time, because a full-time job is typically 2,080 hours a year, right? So that would mean you would have to work 2,081 hours in real estate. And oh, by the way, if the IRS audits you, they say, show me your time log, and you're going to have to document it. And those times can't overlap. There's been plenty of court cases where I said, well, I had free time here at work. I was, downtime or whatever. I made a few calls, talked to my tenants, and the court said, no, you were getting paid by this guy. That's not real estate time. So the structure, the strategy works well is if you have one, especially if you have spouses, one person could be the real estate professional if they don't have a full-time job, or they can have more flexible hours, or they don't work at all. That's ideal, because over more than half their time now is spent on real estate. They spend 1 hour a year. Then you just have to get the 750 hours. The spouses together can make up the 750 hours. So I have a lot of that. I did have a conversation with a couple in New York City. They're both doctors. They bought another condo that they were renting out, and of course they can't write off anything. And they said, how do we use real estate to save money on our taxes? I said, well, first, one of you has to quit. You've got to be a real estate professional. So, now the purpose of an S corp. So what an S corp does with an LLC is that we can take the earnings from the LLC and we can split it into wages and profits. Wages are subject to self-employment taxes, which is Social Security and Medicare tax. So when you work for an employer, they would withhold Social Security and Medicare tax from your check, and the employer has to match it. So basically, the tax rate is 15.3%. You've got 7.65% coming out of your check. The employer matches it for 7.65 on top of that. Now, it turns out when you're self-employed and you're working on your own, you get the privilege of paying both halves. And this is on top of your regular income tax. And it turns out you could be in a situation where you don't pay any income tax, but you still owe self-employment tax. So I call self-employment tax the sleeper tax, because Congress never talks about this. They'll talk about your Social Security benefits, everything, but they don't talk about how they fund it or attempt to fund it, I should say. And the thing is, with an S corp, because you're required to pay yourself a salary, then your salary is what's subject to self-employment taxes. So we can set that at a reasonable amount, and then you can make plenty of profit, much more times than your salary, and you're not paying SE tax on that. Whereas if you were just a sole proprietor, your SE tax are unlimited. Now there is a Social Security wage limit, which I think this year is $168,000, and then but Medicare tax, which is 2.9% of this 15.3, is unlimited. It keeps going up. So profits, however, are not subject to self-employment tax. Only your wages. So if, let's say, for example, you made $100,000. If you weren't an S corp, you just had an LLC, you would owe $15,300 in self-employment tax, and you're going to owe income tax on that too. But you're going to owe the 15.3. But let's say that a reasonable salary for you is $50,000, and you elect to be taxed as an S corp. You still made the $100,000. You're still paying income tax on $100,000, but now you're only paying SE tax on the $50,000 that you set as your salary. The other $50,000, you're not doing that. You just saved $7,600. And that, by the way, that 76, as long as you're making that level or more, that's $7,600 in perpetuity forever. You're saving that for a very long time. The only downside to an S corp is S corp owners must pay themselves a reasonable salary. And I say it's downside because it depends on your profession. So what I usually do is I just Google the profession and the area that you live and just say, what is a reasonable salary? I mean, not that, but what's the average salary? And I pick that. Because one of the things for small businesses, and where I can argue that the amount is less than what you would make if you actually got a W-2 job, for instance, is that when you're the owner of a business, you're doing all the jobs, not just your job that makes you a lot of money. You're doing the clerical stuff, you're taking out the trash, you're running whatever errands until you get big enough, and then you can hire employees to help with those activities. But in the beginning, you're doing everything. So which means you're doing minimum wage jobs as long as the real high-end stuff that makes you a lot of money. So therefore, we can average those in. And so it turns out I've looked all over the United States in a bunch of different professions, and the general thing is 50 to 60,000 is the average salary for almost every profession, except for some of the higher end stuff like doctors, engineers, and stuff like that. So we still have a lower number than what a doctor might make with a W-2 if they have an S corp and they work with a contractor, but it's still more than other people make. So S corps and partnerships. Now, if you have more than one S corp, you're going to have to pay yourself 2 salaries. And so if you start another business that would need to be elected to be taxed as an S corp, for instance, now you're going to have a salary under one, and you're going to have to pay your salary on another. You've just doubled possibly your SE tax again. You're back where you were before. But this is where S corps can own LLCs. This is where you set up another building LLC that's owned by your S corp. It has a completely different marketing arm, whatever it does, and then that income, because it's disregarded, it doesn't file a tax return, but that income from that LLC flows into your S corp, and you're still paying yourself that single salary. You're just reporting more income because you have basically a consolidated tax return. And 2 S corps can partner to avoid multiple salaries. So this is a situation I ran into a few years ago. I had some guys, they owned a roofing company, and they wanted to bring in a third guy as a partner. Now the roofing company was, at the time, it was 2 guys. They were just sort of splitting. One guy had an S corp, the other guy just had an LLC, but then the third guy didn't have any entity at all, and they were wanting to, they didn't want to. If they set up an S corp for the roofing company, they were partners in that. The distributions have to be proportional, so they can't say you're getting 50, you're getting 10, and you're getting 20. Unless that's the ownership structure. But if they're 1/3, 1/3, 1/3 owning it, they'd have to split it that way. Well, they didn't want to do that because the new guy they were bringing in wasn't a full partner. He wasn't like an investor in it. They was just a really good salesman. They wanted to give him a little piece of the action. So I suggested, I said, well, the new guy sets up an LLC that we're gonna elect to be taxed as an S corp. The one guy already had the S corp, the other guy elects to be taxed as an S corp for his LLC, and y'all set up a third LLC that the three of you guys own, and the money flows to the three of you, however you wanna do it, because it's a partnership, and a partnership rules can be a little bit different. So that's where they all could set their salaries at different level depending on what their income was. Instead of having to be in an S corp and they all have to have. So I use this a lot for anybody with active stuff, especially if they're partnered together on a job. So let's say two flippers go together on a job, or a wholesaler and a flipper, and they both have their own LLCs and they're an S corp, but now they can set up another LLC that buys a property, and they can define what the split is for that property. And if they don't do another property together, that LLC was set up, it's called a special purpose entity. It's set up just for that one transaction, and then they can close it afterwards. So there's ways to structure this using S corps and LLCs to help save taxes. Yeah, Blaine.
Quick question, so on the LLCs, like your example with those guys, can you change the LLC you have, or is it better to start over with a new LLC and set the structure up?
You could you could bring the guys in as partners on the existing LLC. The problem is they would need it to be an S corp.
Like, I guess my question is, so the guy that didn't have an S corp, you suggested he have an S corp, can he change his LLC to an S corp? Or does he have to start?
Well, he didn't even have an entity set up. So we set up an LLC for him and immediately elected it to be an S corp because he was going to be making several $100,000, right? So we already knew what he was going to be making. And the fact that he didn't have an LLC when I did his tax return the first year, I said, dude, and he was getting a 1099. I said, we need to get you set up as an S corp. So, I mean, I just had a client that been doing her own taxes for years, successful businesswoman, everything's on Schedule C, and when I get her first tax return, the prior year tax, I always ask for the prior year tax return. And I look at it and I'm going, why aren't you an S corp? You're paying way too much tax. And so we switched her to an S corp for 23, saved her half the taxes she was doing because most of it was self-employment.
How do you elect how you're being taxed? Is it through the Secretary of State website, or is it through something like
It's
your
the
CPA?
IRS.
It's through
So
the
there's a form, there's an S corp election form, it's 2553. You fill that out, you put the date you want it to start, which should be a calendar year date or the first year of the fiscal year. The thing with S corps is they are pretty much the same calendar year as their owners, which happen to be us, and we're on a calendar year basis. So it's usually January 1st. And under the normal rules, when you set up a company, you have 75 days to elect to be taxed as an S corp. Or you have 75 days, which is March 15th, from the beginning of the year to be effective that year. But there's a special revenue ruling that allows you to go back 3 years. So if I have someone who comes in and hadn't filed a tax return for a couple of years because they're just behind, and then I realize they need to be an S corp and they had the LLC set up already, then we can elect the S corp, catch up all the paperwork and everything, and then they're saving a bunch of tax. I have had a realtor come in my office, especially, this was in, when was this, in right after COVID, when things started to just take off. And she came into my office and said, and she basically a new realtor. I guess she'd been in the business for a while, but then, everything was taken off for everybody. And she came in and she goes, I made a lot of money this year. What do I do to save tax? And I said, do you have an LLC? And she goes, no. I said, not much we can do. We can set up an LLC today. The rest of the year, you might have less stuff. But if you had an LLC you already set up, I could go back to the beginning of the year. We could set your salary and we could save a lot of the SC tax. Most of our tax was SC tax. And so I tell people, when you start a business, it's very simple to set up an LLC. Just set it up. It's inexpensive to do. That way you have it. And then if you find the right formula and something takes off, if we need to switch it to an S corp or whatever, we have that data to do that. Or we already have that set up. So basically, use LLCs for liability protection. That's what they're for. Learn the concepts in the tax code. There's a lot of misinformation. Unfortunately, there's a lot of misinformation out there on the internet. You'll look up something. I have people do this all the time. Can I use this strategy? I said, well, yes, but, and we go through the the depths and everything of what it's doing. But there's a lot of guys saying you can pay your kids up to $13,000 a year and it's tax free. It's like, well, yes, except you still have to do all the paperwork and the payroll stuff. And in the state, it may not be tax free, so you might have to withhold taxes. So we talk about those strategies like that. And also buying vehicles and writing off vehicles is always good. Use LLCs for separate income streams. So what I mean by that is rental income is an income stream, flipping income, wholesaling income, realtor income is an income stream. Use different LLCs for those. Don't mix them up, especially because we're trying to avoid the dealer trap and being called a dealer in real estate. Split active activity from passive activity, which is that rental versus flips, and then treat each LLC as a separate business. And this is, I didn't talk about this much, but this is important. It is a separate business, but remember, LLC, limited liability company. The liability protection you get is only good if you're really treating the LLC as a separate entity, which means you're following the rules set up under law for that. You have an operating agreement. Most people don't bother with an operating agreement. Well, if you get sued, they're going to ask for the operating agreement. If you don't have that, they're going to argue to the judge that they're not treating this as a proper LLC. We should be able to go over that after them personally. That's called piercing the corporate veil. Also, the biggie that I see, actually more than an operating agreement, is intermingling or commingling funds, which means, you get company money in, is like you're paying your mortgage out of your LLC, you're paying your truck note out of the LLC. The LLC doesn't own your house, it doesn't own the vehicle. So that's called commingling. It's not a problem for you to pull that money out and then from the LLC and then pay it. It's better just to do it that way than to pay it directly from the LLC. And if you want to get in contact with me after tonight, I'm going to be going to Chimes. This is my website, NortonAccountingServices.com. This is our office phone, 985-690-4498. I think there's some cards also out here on the table. And the email is info@NortonAccountingServices.com. Out here on the table, I have a sign-up sheet. I have a newsletter that I send out by mail every month. If you'd like to be on that list, give me your mailing address and I'll send that to you. If you just give me your email address, I do send out emails occasionally with informational stuff. I'll add you to that list. And then if you have any questions about this whole thing or any other thing related to it, I'll be happy to answer them. Yes.
I have a question about, if you own an LLC as a single member LLC with a subchapter S, do you still need an operating agreement?
Yes.
Yes.
Because
I was under the impression it was for partnerships or multi-member LLCs.
Well, you don't really need an operating agreement because you're it, right? You're the owner, you're the manager, you do everything. So you can make any decision you want to make. What it does is an operating agreement for a basic single member LLC just has all the boilerplate stuff in there, and most of it won't pertain to you. It says the manager has the ability to do certain things. The owner or the members must elect to do certain other things like buy and sell properties typically. Well, if you're the manager and you're the owner, you have carte blanche, you can do it because you can have a look in the mirror, have a decision, and just sign on a piece of paper. But what it does help you is that if you get sued, then they're gonna subpoena a bunch of records and they're gonna subpoena all that stuff. And they're gonna find out that you don't have that. That just gives them a little crack in your armor to try to get through the LLC. I've had guys that have been sued, mainly they're contractors, which is a risky business, and they're building houses for other people or doing work on other stuff. And so they were sued. They didn't get through any of their structure. They tried their best to hammer at it. We had all his rentals set up in different LLCs and everything else going on. They couldn't get through any of the structure. But what they could do is drag the court case on for years. The 5 years of their life was just ruined from the time in there. So you want to have things in place so that when the attorneys look at the data, they go, it's going to be hard to fight through this. Let's just go for the insurance and cash it out and move on with life. So part of the reason for setting up an LLC is to make the lawsuits go easier if you do get into one. Yes.
So what is the benefit to having a single member LLC as compared to a multi-member LLC? It's like I'm a real estate agent. it's just me, I'm a single woman, but I do have 5 children. So is there a benefit to making it a multi-member LLC and incorporating my children, or should I stay as a single member?
There's no tax benefit. If you did that, then they would receive a K-1 and have to file a tax return. So it actually, if they're adults and they're active in the business, then yeah, you can make them members because you might eventually want to ship the business over to them, or sell it in some form or whatever. But just making your kids members doesn't really help you too much. An S corp has to file a separate tax return already, so it already appears as if it's a separate entity from you because you're filing it as an S corp. But just adding your kids just to have additional members doesn't really benefit you from that. Now, while saying that, like for instance in Florida, there was a court case where a guy was getting sued, single member LLC, and it went all the way up to the Supreme Court in Florida, not the U.S. Supreme Court. And they basically said that a disregarded LLC has no liability protection in the state under the state's rules. And so in Florida, if you set up an LLC, yeah, you're going to want another member. They don't have to own much, but you now have a multi-member and you have liability protection because of that Supreme Court case. So I think they interpreted the law incorrectly, but that's what they do, and I didn't read the law. So. Yes.
Yeah, I'm a real estate agent, so if I buy a property with another member and another people like my friend, and we have a LLC, the LLC owns this property. So if I list this property for sale, so now the owner is the LLC. Do I need to say, okay, I'm the owner of this property?
Yes. Well, that's more of the Louisiana Real Estate Commission, right?
Yeah.
So basically that says you're involved in that. That's a related party transaction.
Mm-hmm.
So you would just disclose that, yes, I'm a member of the LLC that's selling this. I just disclose it just because then you're covered. No one cares anyway. So you just put it in the contract and then no one reads those things. So anyway, but yeah, you just disclose it. It's the best thing to do. Any other questions? Yes.
Yeah, any I guess tax differential or owning a property in a revocable trust versus the LLC?
So in an irrevocable trust,
Revocable.
okay, a revocable trust, which is also called a living trust.
Yeah.
There's no liability protection for a revocable trust. So you don't have that. The benefit of owning something in a revocable trust is that the ownership can be anonymous because you don't have the beneficial owner of the trust necessarily in the public record. Whereas an LLC, a lot of times you can look that up and you can find out who owns the LLC. So if you're trying to figure that out. Now in Louisiana, I've been told, and John left, so he would be able to answer this, that Louisiana law actually requires you to put the beneficial owners of a trust in the code so that the land records flow and there's no cloud on the title. But in other states, a lot of people use trusts to buy all the time. A lot of times they'll have the trust and the beneficial owner will be the LLC. So they have the liability protection there, but you don't know that there's an LLC that owns that property because it's owned by the trust. So there's ways to structure that to do that. There is also what's called an irrevocable trust. That's a permanent trust that you set up. They pay taxes like being a corporation. It pays tax. And if you pull all the money out, or you elect to have all the income flow to you, then you pay tax at your rate. But rental losses and stuff get hung up in a trust. You can't take those and use those. So there's some negative consequences for having an irrevocable trust. But a revocable trust is disregarded for tax purposes. The IRS treats it as if it doesn't even exist. Use your own Social Security number as the trust tax ID. So there's no harm in having an irrevocable trust. A revocable trust, a living trust, owning assets because you still get the same tax benefits from it. You just don't have liability protection.
You said earlier, restate that a revocable trust can own an LLC and the property can be owned by the LLC. Is that what you said?
Or either or. Yeah, an LLC can be the beneficiary of a revocable trust. And then the trustee's not gonna be, the trustee could be the manager of the LLC, but you don't know that the trustee's the manager of the LLC unless you look everything up. But, the trustee's name is usually the one that's in the public record, and they're the ones that actually have control of the trust for the benefit of whoever owns that trust. But you could have it for around where that trust, can actually own LLCs as well. So they can own the LLC, and then the LLC can own the property, so it gives them liability protection coming at the trust, so they can't go after any of the other trust assets.
So in that structure, you have the liability protection with the LLC,
Right.
because that entity owns the property.
But what a lot of guys do outside Louisiana is they put every property they own inside a trust, because they're trying to obscure who really owns the property. And then, but there could be just one LLC or person that owns all those trusts. So that trust is set up only for the purpose of owning that property. And then when they sell that property, that trust goes away. They create another one the next time. So it just, they just get thrown away. They don't have to be registered anywhere. It's just a contract between the trustee and the grantor, which could be the same person. You just fill out the paperwork and sign. Victor, you had a question?
Yeah, so in terms of liability, say somebody goes in, and you may not be able to answer this, but say somebody goes in, purchases a single family home and begins renting out a portion of that home. They purchase the home as an individual. Is there a way to retroactively put an LLC in place to protect them from liabilities in terms of renting out their property while they're living in it, and also when they move out of that property and using it as a rental?
So if you live in the property, if it's your primary residence and you rent out a unit in the house or another building that's on the property, in Louisiana, you'll lose your homestead exemption if you put in an LLC. What you could do is you could set up an LLC that manages the rental unit, and it rents from you, and then it sub-rents. It's called master leasing. It sublets out to whoever the tenant is. You're the manager of that LLC. That would give you a little bit of protection, but you would need to make sure that you don't commingle funds. You set up everything. You have all the documents in place, because you need a master lease and a sublease and all this other stuff. If you have the paperwork, the liability protection is there. It helps. But if you don't do all that paperwork, then the attorney's going to go right through it.
Alright, so in that situation, let's say he sets up an LLC to manage the accessible dwelling unit in the back. Is that now active income in that LLC instead of passive because it's just managing the rental? Or can it still be passive?
Well, it could be considered active, but property management is active activity. You're earning a fee by managing properties for others. But if the way I would set that up to avoid that whole thing is that LLC would rent from me, and then it would rent to the renters. And so it's a principal in the deal, because it has rental income, but also has rental expense. So, and the rental expense covers my mortgage and everything, right? So it would be just like I have it, except I have this extra little layer of an LLC in there, and I would set it up that way. I do have people that set up property management companies for LLCs. They put that in the name, but they're really just managing themselves. They're not paying themselves a fee, and they're not managing anyone else's property. They're just using that as a convenient way to collect rents and to consolidate stuff and to pay for things. That's okay. That's not active income, because you're just a landlord. You're just using LLC. You have to call it property management. But as soon as you start charging a commission or a property management fee for managing other people's properties, now you're in an active category.
So in that same vein, if you set up an LLC to manage the property and collect rent and also rent from you, the individual, could you also use maintenance expenses to offset rental income tax?
Yeah, so that's adding the LLC in there, and you're the owner of the LLC, doesn't really change your tax structure, because everything just flows through to you. Whether the property management LLC pays for the maintenance or you pay for the maintenance, you still get to deduct it. Someone gets to deduct that somewhere in that flow.
Can you talk about that new federal thing where is it the federal crimes or something for new LLCs they have to sign up for?
It's FinCEN, it's FINCEN, which stands for Financial Crimes Enforcement Network, which is basically the Justice Department and the Department of Treasury. Congress 2 years ago passed a law that established a database where all small businesses have to register their beneficial owners, which is who actually owns it. Because if you think about it, it's like if you have a Wyoming LLC that owns your Louisiana LLCs, and that Wyoming LLC also owns your Mississippi LLCs, and also, no one can figure out who owns that, especially the federal government. And so the problem is there's a lot of foreigners that own property in the United States or business in the United States and not reporting that income, or at least that's what they suspect. And there's, of course, a lot of money laundering going through the structure, because if it's not being reported correctly, they can't figure it out. So they have a problem when they go and the FBI, for instance, is trying to look at a cartel or something, they can't figure out what they own. Well, if this database allows them to actually look and see, they find the name of it, they can follow it all the way through the chain, who is the actual owner. Because what happens if you own that Wyoming LLC, now even though, and say the Wyoming LLC owns a Louisiana LLC that owns the property, you have to go in there and say, this Louisiana LLC, even though it's owned by the Wyoming LLC, I'm the beneficial owner in it. You have to list that in there now. So it's the actual human being that owns it. And so that's went in effect at the beginning of this year. If you had an LLC set up prior to 24, then you have until the end of this year to register that in the database. If you set up one in 24, you have 90 days to register in the database. And starting in 25, you have 30 days from when you set it up to register. And the penalties, if you don't do this, is $500 a day and a possible jail time. So who knows what they'll enforce and everything, because I'm pretty sure there's a lot of people don't even listen to the news, have an LLC they set up 10 years ago, they're still paying their $30 and they forgot that it's even there. Well, they're not going to collect all those fines from that person and throw that person in jail if they're not doing anything with it. So, but we'll see what happens. There was an Alabama court, federal court, recently that said it was unconstitutional. And actually, if you Google FINCEN space BOI, which stands for Beneficial Owner Information, you go directly to the website, and it explains that. And also has the thing about the court case, which I actually saw in there today and went, oh, let me see what they say, because I've read other articles. And they basically say, unless you're the person that was named in the suit, that defended, or I guess the plaintiff, whichever it is, it's like the person in there, or the National Association of Small Business Owner, it's like, we're going to apply it to them. They don't have to worry about registering right now because they're appealing it. And it's like, but everyone else still has to do it. We're still going forward. Because it's the law. It hasn't been struck down by the Supreme Court yet. So when it gets to the Supreme Court, we'll see what the Supreme Court says. Because I'm pretty sure they're going to, either side's going to appeal it to the Supreme Court or whatever the appellate court says. So, but it could be years before that actually happens, right? So the best thing to do, most people are not doing anything illegal, and it's not really hard. The IRS already knows that you own these LLCs because you're reporting that anyway. Just fill out the database information. The one thing you can do is if you have multiple LLCs, and I've been recommending this even if you just have one, because if you work with me, eventually you have multiple LLCs. You see from my presentation today, I'm all for making sure you got the right thing set up. But you can register yourself and get a FinCEN ID, and then when you go and set up your LLC, you just enter your FinCEN ID number, it populates it with your name and address and all that stuff. And the issue there is that if you don't get a FinCEN ID, anytime your information changes for you, you move to a new address, you renew your driver's license, you got to log on to every single company and update that. And I've got 16 LLCs, that would be a pain in the ass. So I'm going to register once, and then I'm going to go in, and I can just update my record, and it'll automatically update it in all the company records. My companies don't move much. They don't have driver's licenses, so it's like they get there. But when my driver's license renews, I'm pretty sure I'm going to have to update my ID in that database. So, so they have a question on there about why to set up that on that website, and it's pretty simple. Cole set up a new LLC this year and said, "Oh, by the way, you need to log in and do this." And I told him about that, and he went in. 15 minutes later, says, "All of them are registered. They're all done." It's like it doesn't take very long.
So you use one FinCEN ID number?
For yourself, and then of course you register each company. So there'll be a FinCEN ID for each company. But if you don't register yourself, you're going to have to enter your data every single time, prove who you are, upload your driver's license, everything for all the different entities that you own. But if you do the fence in once first, then you just populate that and it pulls all that stuff in.
I've got a solo 401k that has an LLC. Would I register myself as a beneficial owner?
That's a good question. That might be exempt from doing that because it's owned by an IRA. So there are some exceptions to it, but if it's owned by individuals, so that would be something we'd have to look up to find out. But there, if you go on the website, they say who has to register, who's exempt from registering, and list that. Like really huge corporations don't have to register. Most of them are publicly traded, and they already know who all the, well, they don't know who all the owners are on the big ones, but they know who runs it. And they have to follow enough stuff with the federal regulators that they're being regulated already. They don't need an extra layer of stuff in there. Someone else have a question?
What are the top mistakes that beginner investors are making tax-wise? They're just starting out with a few properties.
So the biggest thing I see is that they'll buy a property, and they'll hold it for a period of time, and then they'll sell it, and they'll have a huge gain on it, and they don't realize they owe a lot of tax. And we could have done a 1031 exchange, or we could have done something different to defer that tax, so that you wouldn't have to come out of pocket. And I just had a conversation today with a guy who did that. And I really hate it when someone calls me and says, hey, I just sold my house, my rental property. I want to do a 1031 exchange. I was told you were the guy to call. I said, you closed on it? Yeah. It's like, too bad, you're paying tax. There's no, you can't go back. The guy that was with me today is like, is there any way we can do some paperwork? Like, no, that's called jail time. Yeah, I don't do that. That's tax evasion. So, but that's one thing where they sell a property and they don't realize there's these other opportunities out there. That's pretty much the biggest thing. The other thing is they don't keep their records well enough so that when it comes tax time, we can't write off as much expenses as possible. They could say I spent $50,000 on rehabs, and fine, we're going to depreciate that over 27 and a half years. But if they came in and said I spent $5,000 on this and $10,000 on this and $3,000 on this and whatever, now we can break those things out, accelerate depreciation on that $50K, and some of it we can write off the first year, and that saves them a big amount of tax.
Are there any tools that you can think of as far as tracking mileage or tracking expenses that you use that would be helpful?
Yeah, so I use MileIQ to track mileage. There's Hurdler, QuickBooks has something. MileIQ is consistent and works the best. I was using something called Everlance at first. It stopped working. I guess it updated the program. I didn't update my iPhone. I didn't know it for a whole month. And I looked at it and went, it was off. Like, what's going on? So MileIQ hasn't failed. It's been there the whole time. At the end of the year, you can log on. Basically, you just swipe your phone right or left, depending on what kind of a trip it is. And the cool thing about MileIQ that Everlance didn't have in it, they probably do now, but if you take a trip 3 times and you swipe the same way, it comes up and says, hey, you swiped this 3 times. Would you always want it to be this kind of trip, personal or business? And I go, yes. And so I'm swiping only 10% of the trips because I make so many business trips the same routes, right? And then that's helpful. So I just have to have a reminder on my calendar on the first day of every month of like send the report. And I go on my phone, swipe the few trips I made that I had that it didn't track for me, and then it emails me the reports. I download those and I save them. At the end of the year, I have the reports, but I have the PDFs to back up my knowledge. For time, if you're tracking your time for a real estate professional, I have some clients using an app called Clockify. It's a similar thing. You just put in some time. That's probably a good one to do. There is another software out there that I haven't really looked into, but it's called Rep Tracker. So real estate professionals, REP. So a lot of real estate professionals just call it short for Rep. And it tracks in there. It's designed specifically for tracking real estate professional hours. I have one client using that. I don't know how much she pays for it. I guess I'll find out when I do her taxes. But either one, anything is good. The one thing that the IRS will do if you get audited and you have mileage expense on your tax return, they say, show me your mileage log. 90% of people out there don't have a mileage log. They're just guessing at the miles. So the IRS immediately says, well, we're not going to accept this number because you can't justify it. So MileIQ helps with that, or any other mileage tracker. And then the other thing is if you're claiming to be a real estate professional, they're gonna ask you for your time log and they're gonna check that. And so, especially if you have a W-2 job and you wanna be a real estate professional, you're gonna want to track that for a while. If you're a real estate agent, full-time, and you have some rentals, it's pretty hard to argue you're not a real estate professional. You may not, if you only have one rental, it could be hard, you could argue that you're not, because there's also a 500 material participation hours, and it's not taking you 500 hours a year to manage your one property. But if you got 10 properties, you could say, yeah, it's like I'm doing that. And if you're doing your own rehab and maintenance and stuff, you're spending some time on your properties. So it just depends on a fact by fact basis.
Great.
Yes.
You said earlier, you have an LLC over here that's the property management entity, and you have another LLC that owns the properties. So if the one that manages the property, collects the rent, they pay for expenses and maintenance, how does that work if it's an expense, a larger expense that would go to the basis of the property? If that property management entity paid for that, I don't know, $10,000 roof, for example.
Well, so it would deduct the 10,000 from the 10,000 in rents collected, right? And then it would prepare a report and give it to the LLC that owns it, just like any property manager would. You track that. What usually happens is when you have to repair a roof and you're a property manager, you call up the owner and saying, roof repair, 10 grand, send me a check. So that's already taken care of because they've reimbursed you before it actually happens. And so you just do those same flows, and then you're just not managing other people's property, so you don't have that issue that goes along in that.
So that 10,000 for the roof goes to the basis for that.
For the owner of the property, right? Because they own it,
Yeah,
so they're the one that get the basis and depreciate and everything else.
Right, it's the same person.
Right,
all the same
and it all
person.
flows through to you, right?
Right.
Would you say an example with the management company owning the individual property in the LLC, for liability purposes, if something was to happen to that individual house, is the management company tied into that?
So if the management company caused the issue for liability, then they're going to be sued. And the owner of the property, when they find out they're just a management company, they don't own the property, the owner of the property is going to be sued. And then having the LLCs in there is makes it harder for the attorneys to get to your assets and actually get to some of those things. And so usually what happens when you hire a property manager to manage your properties, in the contract they have different obligations and stuff. And so there may be indemnifications, which means you agree to defend me in case this gets sued, vice versa. Usually it's something that the property manager indemnifies the owner for any harm the property manager caused, but then the owner indemnifies them for anything that's related to the property. They usually have those mutual indemnifications. If you're both sides of it, it's like you're just trying to keep from everything you have going away because of a single lawsuit. But there are some gurus out there on the internet saying set up a property management company because that's the one that's going to get sued if anything happens. It'll protect you or whatever. And it's like, well, no, the property manager, the property owner is going to be sued every time. Because the first thing the attorney is going to do is look up who owns this property. They're going to sue that person or that entity. And then they're going to sue everybody involved. And now it's just a matter of who's really responsible for it. And their insurance companies are defending them or getting them knocked out of the lawsuit to where there's just one man standing that has to pay for it. Is really how it works. So you want that process to be as fast as possible by setting up some of these structures.
I have enough time for one more question. Anybody? Yep,
Two-part question.
that's fine.
It was two questions, but now it's two more. All right, go for it.
So if I have my LLC set up in an Amity state, which owns a property in Louisiana, do I have to register that? So say the holders company out of Wyoming do business in Louisiana?
You should, yes.
Okay.
So if your LLC, if your Louisiana property is owned by your Wyoming LLC, then that Wyoming LLC should be registered to do business as a foreign LLC in Louisiana. It's still, the issue with that is Now they're gonna wanna know who the manager is. Louisiana asked that. And it can't be, the LLC can't be itself managing. So what usually, the way I've structured it in the past is we set up a Wyoming LLC, and we set up a Louisiana LLC owned by the Wyoming LLC. The Wyoming LLC shows up as the manager. And when they go look up the Wyoming LLC, of course, they only have the registered agent, doesn't have anyone listed. So that you can't get to that. And of course, your Louisiana LLC has a registered agent locally that's not you, right? For the same reason. So you're spending, if you want anonymity, you're gonna pay a little extra for it because there's a lot of extra stuff that you have to set up. But there's ways to do that in pretty much every single state. And then, of course, this beneficial owner information database from FinCEN we talked about will eventually blow that out of the water because all it's gonna take for anyone to open up that database is to get a subpoena from a judge. Well, that's what happens in lawsuits, and that's the whole reason you're being anonymous, is to try to minimize lawsuits. But then they just go and say, everything that's involved in it, they're gonna get a subpoena from a judge and then go to that database and they're gonna unlock it and search for whatever. So that's why it's being sued.
Yeah. Bonus depreciation, right? Wasn't there some kind of, I guess, hold up in the government about 100% bonus depreciation?
Yeah, so before 2018, the Trump tax law came in, we had bonus depreciation 50% when you bought a new asset. And this was new, never used asset. And then in 2018, they changed it and said, we're gonna bump up, because we need to stimulate the economy, we're gonna bump up the bonus depreciation to 100% for any new asset to the company, which could be, you could buy a used asset, but it's new to you, you get to depreciate, it's never been used by you before. So that was 100% through 22. And in 23, it dropped to 80%, 24, it's 60%, so it's going down. In March of this year, the House of Representatives passed a bill that reinstated it to 100% for 23. And it's now in the Senate. The Senate hasn't budgeted on it yet. Now, that's not the only thing in the law, right? Because they're arguing over all that stuff. So what most of us are doing is telling our clients that have bonus depreciation, wait to file. Let's find out what the Senate does. So we don't have to amend the tax return and charge that. So that's basically what's happening now. But I have some clients that said, no, screw it, file it. I just want to get it done. So it's like, okay, you're just getting, but you're still, for 23, you're still getting 80%. So that was fine.
They still haven't approved it yet.
No, Congress, the Senate, I check every week, Senate hadn't budged on it. They're still arguing it, so who knows? And then, summer recess is coming up soon, so we won't see anything until the fall. This is an election year. No one wants to probably touch it, so, there's, who knows? But, based on what I read, it seemed like it had a pretty good chance of passing. It's just a matter of when they can get enough votes to ensure that it's going to pass. So otherwise, they put up for a vote, it doesn't pass, and it goes away. It's like, so they have to start all over again in the House. And it's like, so they don't vote on anything until they know that they can pass it, or they just shelve it and hope everyone forgets about it. That's how the politicians work, right? So,
Well, thanks for coming, Buck. We were
thank you.